Welcome everyone, to this exclusive Investonomics session by ICICI Securities. Our endeavor is to get the industry experts on this session to talk about markets and how macroeconomics and microeconomics will kind of impact stock markets and an investment portfolio. So we've got a very special guest, Prakash Diwan, with us. He's a market veteran. I'm sure many of you would have seen Prakash. I don't have to give any introduction of him. Prakash, just want to kind of get started into this and where we are today in markets. Obviously we had a dream run. Something which actually I would say millions of investors have benefited from the dream run, because when it started, there was COVID, and that's where the surge of investors were. So so there's a significant upside and runway that everybody's seen. But unfortunately, last 3 to 4 months have been, kind of really sluggish. Portfolios haven't kind of done well. The new investors who've gone to the market, over the last few months haven't seen, kind of great returns. And, with so much of geopolitical issues which are there today, and this is a kind of a different nature of geopolitical issues that we're seeing right now. When we saw something with India, I'm saying with India, Pakistan, or some geopolitical issue, it was, for a day, few days. Here and you're seeing 100,000 troops on the borders. It really has a toll on economy. It's not. Is it more posturing, or do you think this is something which is more real, will impact global trade, global commodity prices, and hence markets? I mean, how do you see this playing out? First of all,
thanks, Saurav. Thanks for putting it in context, and thanks for having me on this interaction. I think you guys at ICICI Securities have done a tremendous amount of work in terms of getting newer investors, newer people in the market, and educating them is a must. When we get into markets, it's always the different triggers, but we want to make sure that people don't pay a very high tuition fee to understand what this jungle is all about, right? And you're right, the volatility that's currently prevalent post the pandemic from March 2020 is of a very different nature. It's a very, very different environment that you're talking about. Things happen too rapidly here. Things get disrupted much faster than what you would anticipate. My experience in the last 20 years tells me what is happening in the last few years is far more different than the earlier 15, 18 years that I've been. So it's very clear that newer investors will have to be very agile, very adept at adapting to changing situations, responding to the changing environment, and more than trying to excel at anticipating what's likely to happen. I think the ability to respond to changes is going to be a superpower in the market. So, for instance, as you rightly said, the volatility that currently we are witnessing on the geopolitical side, it's of a very different, unprecedented scale. We are talking about a large superpower or ex-superpower, if you will, like Russia, to actually go and militarily attack or respond to react to a situation. So it's not something which is a skirmish, which is regional, which is two small neighbors warring over water and some land disputes. This is much more than that. So I think the geopolitical situation is a very unprecedented scale. You have interest rate scenarios which are also so disruptive. We came to a situation of zero interest rates, and now again, the journey is going to reverse. So in that environment, look at the commodities are behaving. I've never seen crude so strong, and still people are talking about $120, $125 on the back. There's so much of uncertainty. So I think it's important that we help each other as investors, as participants, understand what is it that we need to take away from this. Are there advantages of this volatility? And if yes, how do we take advantage of that?
Prakash, I mean, pretty interesting that you spoke about, being agile as investors, and it's a very different kind of ecosystem than what has happened in so many, last few decades. So by agility, would you kind of refer to so there are two kind of investors, right? One who already are invested, and many of the investors who've been in this market are kind of fully invested, and then there'll be a new kind of investors who get in. So would you advise them to lighten up portfolios uh, when this kind of volatility, which is there, and let's say things really become, I mean, there is geopolitical tension, I mean, there is war, or the interest rate cycles are going up. Would you want advise people to lighten up portfolios? How do you kind of advise them to tread this market?
No, absolutely. So I think it's a very valid point. What matters to investors is what happens to the portfolio. I mean, broad indices, headline news flow is all aside. But what's it doing to your portfolio is more critical, more relevant, right? I mean, if your portfolio is down 30% and the market is up 5%, there's not much you can do to rejoice. But the whole idea is we always have to focus on portfolio construction, on our ability to uh, structure the portfolio, tailor the portfolio depending on what our needs are, what our goals are, right? And that's what I meant when I said respond to market situation. Now I'll tell you why. There was a time when I started my investing career, we always looked at investing in a 5 to 8, 10 years horizon. And the generation before us have actually made money by holding on to stocks for 20 years, 15 years, and it's folklore how somebody who bought Wipro shares is now worth crores, and HUL, and I mean there's so many stories, right? The
Yeah.
reason why holding periods are coming down, sort of, and that's a very important environmental issue that we need to accept, is the information flow around businesses is very fast now. Every quarter
Mm.
you have a company giving you such detailed explanation on how the business has been, which was never the case earlier, with such high level of high degree of granularity. Today you have a company that gets a big order, it's posted on the exchange immediately. And earlier, all of this used to be a matter of conjecture, matter of surmising and anticipating, but you didn't have so much of granularity or accuracy levels around that. Now, because of that, if I have a stock in my portfolio and something adverse happens, and I have the information, there's no harm in responding to that piece of information, to that development. So, by saying that, oh no, you know what, I am long term into this business, but there's some event that's happened and it's dramatically going to change the fortunes of this company, at least for the next years, I need to respond to it. So by virtue of that, there's no harm in adjusting your portfolios, realigning your portfolios a bit more frequently than what we.
Yeah.
That's what I'm trying to say. I'm not trying to push people to trade. We are
No,
talking
absolutely. I understand.
of your long-term orientation, but with the readiness to tweak our portfolios as and when the situation demands. And coming to your question on what should they do, should they lighten up, should they add more? I think it's more to do with asset allocation. At the end of the day, if you have X 100 rupees to be put into equities and you are invested 80, you have the dry gunpowder of 20 to still deploy as and when things go up. And when you buy, most of us buy stocks. We don't buy the
Yeah.
broad market, right? And by virtue of that, always keep a list of stocks ready that you would like to buy at lower levels. So whole feeling of having missed out can get converted into an advantage by saying, no, I'm going to restrain myself from getting FOMO. But here's a list of stocks that I believe have great long-term growth potential. And as and when they offer a better valuation metric or a softer valuation, or they lose some ground because of other issues and not necessarily the company specific issues, go ahead and buy it. So I think it's more important to understand that stocks at times react. One is because of the environment, which is called the systemic risk, and the other is a systemic, which is specifically to their business. Everything is good, but the stock has some adverse development and it reacts. You buy those stocks when they come down because of the environmental risk or the systemic risk, because there's no reason for the company to be put under strain. It's just a price that's moved down, and that's when you kind of latch onto it. So people need to understand good news I mean, stocks falling is at times good news, especially if the reason is more geopolitical or driven by liquidity flows. FIs are selling out, and they just have to go out. And if they're getting out of a stock, it will have liquidity pressure. It will come down. The price will come down. You have money to buy into it. You don't have any compulsions on allocations or exits, and you can go ahead and buy. So retail individual investors have to behave in a way that's specifically good individually and not ape the market, not go by what the FIs are doing, not go by what institutions are doing, because everybody has a different texture of expectation around the portfolio. So I would believe the market is giving us opportunity to churn a portfolio. Yeah. Keep stocks, keep fewer stocks in your portfolio. Don't expand and go to 40, 50 stocks. Keep a concentrated thing of 15, 20, and that's also not very concentrated, but at least 20, 22 stocks is a good number to grapple with. And keep on adding more to businesses that you feel are doing well.
Well, sure. No, I think pretty interesting, and I think very wise kind of advice. And I kind of look at two things that you spoke about. One you spoke about that, companies which are doing well, and there's no company specific issue. What you're saying is hold those stock and no money. I think that's, when we look at markets for last 20 years, that's where real wealth creation has happened. If people have gone into great companies and, and they just held on and, kind of average it and, kind of keep on investing. And I think what you also spoke about is the agility to move out of companies where you're getting, a sense of, things not going right with that company. I think that's what, I get the message, very kind of wise, thought process. So just a couple of more questions on general markets, and I come to liquid and stocks also. First of all, FIs have been selling like, there's, I don't know what, they sold 100,000 crores over last few months. And why do you think that kind of, sell number every day, you wake up, you see around 1,000, 2,000 crores of selling from FIs? Is it just to do with the fact that, rates are increasing US and, the money, the hot money, which was earlier, there because of so much liquidity through central banks, and that's ending? And is that the only reason? Or do you see, where, India versus, let's say, emerging economies, do you see India being, singled out for further? Why do you see FI selling so much in Indian markets?
Oh, valid. That's a very valid point, because, every time FIs exit, there is a significant element of impact on stocks, particularly the ones that they're heavily invested into, which are blue chips, large caps, names. The reason why FIs, you have to put the FI action in context. And let me give you some statistics. From a market cap perspective, globally, the US is about 55% market cap on the global market cap, as a percentage. We are not even, half a percent, beyond half a percent. So what happens is the money that had come into India was just an allocation on the basis of some emerging market allocation that they would have to make. And this particular allocation can come down drastically. Can come down drastically if the call is to take all the money into some other promising market. Now, suddenly, all the excess liquidity which the markets were awash with is actually now the tap is drawing to a close. Okay, somebody is turning the tap off in terms of liquidity. So I don't have so much of money as an FI to deploy and slots around elsewhere. So I take it back to my home market, right? Because that was just liquidity that saw coming our way, and a lot of other emerging markets. Now, once that stabilizes, once they feel that the interest rates in the US have stabilized, things are kind of looking slightly more even, they will have to start reviewing their allocation in emerging markets again. And if India happens to be still a promising spot in the global setup, in the emerging market setup, I'm sure we will see money coming our way as well. So this is temporary. And FIs behave the way we would behave. If a particular asset class is not doing well, we pull out of it because we found something looks more promising. And that's what's happened. The context, the scale is much bigger, and that's why we get a bit upset. Or it kind of, is inhibiting for the markets.
Yeah, no, I kind of agree. In fact, it's the domestic money which is holding the markets up. And had there been some support of FIs, I mean, I'm sure we would be at a very different level. It's just that, I mean, the domestic money is really kind of held markets. Okay,
Yes.
so just to kind of look forward a little, and a little means, I mean, I just few months only right now. There are a couple of triggers on the markets, right? One, which kind of markets knows about is the other rate hikes. I mean, when do they start? How many rate hikes happens? That's like a global news flow which will keep on coming, and I don't know when to end, but will keep on coming every quarter or every month rather. That's one. Second is the interest inflation, which I think kind of being spoken about. I want to kind of get a little deeper as well in that also, because that has a lot of second level, third level impact, right? I mean, high inflation. The third is from a domestic point of view. The 5 state elections. The results are due in March, right? And if it's what I mean, historically what markets have kind of looked at as strong governments, it kind of then gives a runway for 2024. So I mean, what do you think? And then there is monsoon. I'm saying, so there are so many things which are there in the next 1-2 months. What do you think are the key triggers over the next few months, and where do you think markets kind of you see markets? How do you think markets doing?
Yeah. Okay. So very, very valid, and this is a universal issue, remains all the time. It's all seasons as a predicament for investors. Saying what are the triggers to look for? How do you anticipate? How do you overcome? Stock prices have two components of movement. I mean, I know I'm talking about a very basic thing, but just to kind of put things in a simplified contextual thing, it's the EPS and the PE multiple, right? Now the market, what we are seeing today in terms of liquidity issues and all of that is the PE multiple contraction. People are taking out money, they're selling stocks, and that reduces your PE multiple. But is the EPS also contracting? And the answer is not really. I mean, we've seen this last quarter that went by. A lot of the good businesses have improved their earnings, and they could continue doing that in the Jan-Feb-March quarter. So by the time earnings are out, results for March end and the whole year are out, and if the earnings are not getting impacted negatively, I think the market will take cognizance of the fact. So if the EPS remains better or improves, while the PE is softening, you know that at some point in time the PE will catch up and may go up, right? So that's what you have to look. The market is always a slave to earnings. If companies earn, PE multiples could expand, contract, whatever happens, but at some point they'll catch up because earnings are a fixed metric, are a robust, very strong foundational metric. You can't have earnings being debated. Once earnings are in place, when the results are in place, you know that the company has earned and it will earn X number of rupees next year, and that keeps on going. The key triggers, if you ask me, are fairly different than what the market is building in terms of this geopolitical crisis. I think the geopolitical crisis is born out of a lot of vested interests from the powers that be. The US doesn't want Germany and Russia to get together. Russia doesn't want to let go of Ukraine and the resource base that it has. So there's lots of arguments. And in a multipolar world, we have to live with conflict. Okay, so I don't think conflict is new. It's going to be here. It's going to remain, and we have to take advantage of that. So it's giving you the opportunity to buy. Now the interest rate hike may not be as innovative or as unfavorable as the fear of the hike was. So the fear of the hike has been tremendous, right? As if the world's going to come to an end. But what it tells you is that free money or easy money is probably going to come to an end. But good companies that continue doing well will still be sought after. Yeah. All the weak stories and narratives that were doing rounds in the markets are the ones that lose ground. But if you have capital gets precious, it will still chase the good business. I think the budget has been very positive. If you ask me, the RBI policy post the budget was very conducive to growth. It hasn't set off any alarm bells on inflation and all those things. And the UP election outcome, more than the other 4 states,
Yeah.
is also going to be a little bit of a much watched after or sought after kind of a result, because it tells you how policies would kind of change and adapt to the run up to the next general election a couple of years down the line. So I think the cocktail is pretty heady. But end of the day, if you have invested into a business that's doing well, I don't see any reason why you should be worried about it not attracting the right PE multiple. It will happen, if not next quarter, next half or next year or whatever. And that's why long term, it's easier to invest for the long term. For a trader, it's very difficult. Yeah.
Yeah,
absolutely.
absolutely. No, absolutely. Sorry, I just was completely, agreeing with what you said. Two things. One, I heard you say a lot that it is the individual company that you're investing in. If that's right, I think you should be sorted out. I mean, that's really important when you're making that decision. So I think, I think it's a fundamental point, and I completely agree that, for a life of a trader, who's there in the market for a month or 2-3 months, those are very different kind of, ecosystem, and those are different kind of challenges. So, I think we have to cater to both our customer segments. So, just to kind of build on 2 aspects, actually, one is from a trader and one is from, from an investor, actually. From a trader, from an investor first, actually, where do you see are the pockets of opportunities? Which are the sectors you think are seeing that kind of demand, that you spoke about, and which is essential, right, for EPS to kind of sustain, the company's profitability, sustain. That's the only thing, thing. So, which are in your mind top 3 sectors, which are, will kind of continue the earnings growth?
So, I have always felt money making in India or wherever in most equity markets is easier if you are slightly contrarian. You don't have to just be contrarian for the sake of being contrarian, but don't look where, this is a very famous quote on the ice hockey side, that don't look where the puck is. Puck is that thing that you move around when you play ice hockey. Look where it's going to go, right? So if you ask me, it's very important that we understand some of the sectors in India which are very talked about or which are very extensively discussed. There's a lot of expectation that's built up, and that expectation rides into the prices as well. So, for example, electric vehicles or battery or renewables, or these are things that are being so hyped up that anybody or everybody who's even a minor part of that value chain has been amply rewarded because of the PE expansion. The EPS hasn't changed, like shot through the roof. Now that happens with sectors that are over discussed or over discovered and hyped. If you want to make money, value lies in sectors that are still not discovered or people are still not looking at them with so much of promise. So, for example, I'll give you 3 years back, chemicals was something nobody wanted to even look at, saying, companies are too small, they're not consistent, they're subject to regulatory issues, and everybody ignored. So you look at where a Deepak Nitrite was, you look at where a SRF was, you look at where a Naveen was, and look where they've been multi-baggers primarily because you bought them at a time when nobody was interested in them. So by virtue of that, look at sectors which nobody is interested in. And I can tell you, even now, sectors like coal or mining equipment, we're talking about a lot about commodities and saying coal is going to be very elevated, and aluminum is doing great. It's in a super cycle and blah, blah, blah. Now, all of this needs mining equipment, and there are very few companies in the listed space that participate in that. So, but if you were to dig there, you will find companies haven't seen any kind of a run up. So, so there are lots of companies which are into drilling. There's lots of companies which are into capital goods related to material handling in mining, compressors. There's so many. Now, the same way you look at automobiles, this whole thing of automobiles having gone through a big slowdown because of semiconductors is known. So everybody's priced that in. But if the semiconductor supply issue is sorted, you'll see a restocking and a revenge buying of sorts for automobiles, which is going to be very ferocious. So be prepared for autos to lead the pack. From a contrarian perspective, it's time to kind of, it's probably bottoming out. I can't time it perfectly, but at some stage, the world will open up, has started reopening. Look at how Europe has reopened. Look how Asia is talking and making noises about restrictions going out. When that happens, there will be a significant amount of growth there. And some of the pockets like housing in India. So, we undermine the fact that the Prime Minister Awas Yojana is actually talking about the outlay, which is going to cover 38 crore, 38
Lakh crores.
Yeah, so it's talking about 8 crore houses, and an average, if you see a family in India, it's about 4.8. Empirically, it's not an exact number, but 4.8 members make a family. You're talking about 38 crore people will actually be housed. Okay, and that's a huge market that's opening up. So
yeah,
building material, home improvement will continue to do well. So I think these are pockets. Textile has started doing well. There was no we were never known as a global exporter of garments. Today there are some companies that are doing stupendous amount of work in globalizing themselves. Look at the likes of Gokuldas Exports, a small company like PDS Multinational. There are platforms which are creating so much of opportunity on exports. You go into a UK store like Primark or a M&S, you pick up a piece of garments, or you'll be surprised it's either made in Bangladesh or in Vietnam or in India or in Sri Lanka, right?
Absolutely.
And there are companies that are riding on this value chain. They are Indian companies that are sourcing it from these markets and supplying to the likes of Primark and the stores outside. So there's lots that's afoot in terms of Indian companies participating in sectors that were earlier out of bounds for us. It was always the Chinese or the Japanese who were good at certain things, or the Europeans. So we've started making lots of headway into these sectors. So I think capital goods, automobiles, specifically OEM, the larger manufacturers.
Yeah.
So those are textile, as I mentioned. These are great value plays, even available right now. But it's just that I would like to stay away from EVs and chemicals, specialty chemicals, because they've already been discovered quite well.
No, absolutely. I think your philosophy is pretty interesting of looking at stocks which are still, not kind of hot stocks like the tech stocks, which and obviously there's significant value creation which has happened in tech stocks. But just to kind of understand, two sectors, perhaps actually three only. One is on the IT stocks, and if you look at the mid cap IT, it's kind of corrected quite a bit over the last few months. But we see people around us. We see the kind of demand which is there on this sector. Not just, I'm saying, Indian weavers, great service providers outside India, but even in India, the kind of tech demand which is there. Do you think, are we just on somewhere in the middle of the cycle still? There is huge runway over the next few years. I'm not talking about immediate 1 to few months. Or do you think kind of played out? And what do you think about the tech sector, mid cap ITs more so?
No, I think I have a slightly contrary view there, and I believe there is still lots of headroom for growth for IT. While we see the correction, which is fairly recent, and that's just about a 10, 12, 15% correction. It's not something which is very drastic. And the reason why you've seen this correction is a lot of the FI money has been pulled out of these IT names. So the larger names like HCL Tech, Wipro, Infosys, TCS had loads of FI money sitting on, out there, and then that's gone out. So there has been some selling. But is their business at risk? And the answer is absolutely no. If you look at the granularity of the commentary from managements of these companies, you realize they are running short of people. Okay? They don't know how to manage their wage costs because they have to pay 1.3, 1.5x of what they were used to paying for the same talent. Yes. Now the reason why it's happened is because suddenly there's so much of demand. So what it happens, the cost has gone up. So the last quarter you saw, everybody reported higher costs. So the margin was impacted, and that's why people didn't like it, because you started
Mhm.
expecting that everybody should, do well every quarter, right?
Yeah.
So that's a general expectation that happens. But the moment new contracts get reset with higher pricing, and some of these companies will have the ability to be able to pass on those prices, there is no reason why IT companies will not see their margins come back to earlier levels. And as and when that happens, you'll suddenly have a scramble for buying those stocks as well. So I think IT has enough space. You have to look at businesses which have core competence or niche, which niches which they are very good at, where they can get market share, they can get pricing power. And I told you, come April, the kind of restocking and reordering that's going to happen globally. Forget about India. We have
Mhm.
been opened and reopened many times in the last year and a half. But I'm talking about globally. I can tell you there are lots and lots of budgets which are getting expanded because they have accepted the fact that the pandemic is behind us. Now, if that were to
Yeah.
happen, IT is definitely the first to fly off the handle. So I'm quite positive on it. Some of the businesses are available at historically, if you see from historical averages, probably at higher valuations, but the earnings will catch up there, and the valuations will also expand.
Hmm. Sure. No, it's pretty interesting, and it's been a genuine wealth creator. And I mean, I think the kind of employment and everything, I mean, this sector is generated is really key for the country as well. Just one view on I mean, a relatively smaller sector is real estate. I mean, you see action coming back here. I mean, I was reading about the DLF Motinagar property kind of really been within 2 days, or a week or so,
Yeah.
it was kind of fully sold. The new property in Lower Parel, in one of the builders also kind of was sold off within a week's time. Are you seeing those days back? In terms of not stock prices, but in terms of property demands. Which we had somewhere closer to 2002, 3, 4, 5, 6 era. I mean, is that a sector which you think there is strong underlying demand in real estate?
Absolutely, absolutely. So I think you're very right. As a sector, if you see the underlying demand vis-a-vis the supply or the inventory that's available, there's a huge mismatch because for the last 3-4 years, nobody added inventory very wholeheartedly. Okay, so
Yeah,
people
yeah.
were trying to complete what they had started, and a lot of them struggled even there. So you've seen a lot of consolidation there, which means the small developers started left it midway because of shortage of funds, because of inability to comply with the newer regulatory
Where,
changes, and all.
actually, it's been really positive for the sector. I mean, they really
Yes,
made the
yes,
sector much more disciplined. Otherwise,
yes.
yeah, sure. Please
Yeah,
go
so
ahead.
this
Yeah.
discipline, yeah, absolutely. This discipline has helped consolidate and make it much more clearer, transparent, and cleaner, right? So what it does is it reduces the number of players to a stronger batch. It's like any other evolution and Darwinism, right? So the weaker players get weeded out, the stronger ones become stronger, and they take on the market. Now they are looking at increasing the size of the footprints. Every developer that you talk about is not trying to complete projects, but they're talking about announcing new projects, launching new projects. Construction technology has changed so much that you can finish a project much faster. So,
Yeah.
by virtue of that cycle, I think real estate is going to be extremely positive. Extremely positive. So I'm very constructive on that as a sector. You have to be selective because it's very location specific,
Yeah.
right?
Yeah.
Two real estate players are the same kind of size, let's say, but one of them is in Mumbai and the other one is in Nagpur. There are different dynamics working in terms of demand and supply for them, right? So you have to kind of be cognizant of that fact. But I can tell you, NCR hasn't seen much of presence in real estate listed place. It's now that some of the names are getting discovered. The same Bangalore has been a great market. IT spends have gone up, salaries have gone up, but the prices of housing hasn't gone up. I still know there are houses available at 2017, 2018 levels, marginally up because of raw material increase, but otherwise, you still have pricing which is still very manageable, whereas the salaries of people have gone up significantly in some micro markets. So by virtue of that, it's going to happen. Housing finance companies have the advantage of borrowing at such low cost, deploying home loans that were the historically lowest range.
Yeah.
So
Yeah.
all that is very positive, but the cycle will probably give you the maximum advantage in the first 2-3 years. Then, of course, it starts like anything else. The curve is flattening out. But the best returns will probably be made in the next couple of years.
Sure. No, that, pretty interesting. One of the large sectors, which kind of is from a trader investor perspective also is the bank nifty. The banks actually from a fundamental perspective first. Do you think the story is done? More so because the banks had a great runway on lower interest rates, and because that kind of gave great margins, and so I think that was one really, I mean, the earnings kind of multiplied there. Obviously, banks have also cleaned up significantly over the last few years, so that NPA fear kind of now is a thing of the past for many of the banks. But do you think now that with the interest rate cycles going up, the big play in the banks is done?
Oh, I don't think so. In fact, let me put it like this. The banks, larger ones especially, started early, but the smaller ones also couldn't keep themselves away from that cleanup cycle or phase that we've seen. The last 3 years have gone completely devotedly into just cleaning up balance sheets or resetting balance sheets. So the repair has taken 3 years, 3 long years. Most of them are sitting at at a juncture where they can actually start lending in a very qualitatively favorable way. You look at ICICI Bank, or you look at an Axis, or you look at some of the larger PSU banks like SBI. I don't think I have seen balance sheets improve so clearly, so distinctly, definitively in the last 8-10 years. Now, what my belief is, why I'm very positive on that sector as a whole, is though people think it's run up and there are lots of issues, regulatory overhang, that always remains. I don't think that's going to go away, and it should remain.
Yeah.
When the government has announced in the budget about such a huge capital expenditures around, there is a multiplier effect which is almost 1.5 times of order booking that will go to corporates. Who, end of the day, when the government spends, they don't do it themselves. They give out orders, and when when those orders populate down, people will need to build capacity. Now, when they build capacities, they will need credit. Nobody's going to fund this entire order booking and contracts that people get by their own equity. They're going to borrow, and when they borrow, the whole cycle, the credit cycle kicks off, and banks are sitting right at the top. They have clean balance sheet. Everything of the past is gone. They can lend afresh. They can grow the way they want and pick and choose credit to the borrowers that they want to. And let me tell you, interest rates, when they go up, historically, banks actually end up having to create lesser NPAs, because when interest rates are high, only the ones who have the ability to pay will get funds.
Yeah.
Unlike when money is easy, and a lot of people end up getting it as well, right? And that's where you actually cheat the NPA cycle. Whereas higher interest rates is actually a much better environment for banks to make money. There are better margins and higher quality build up also. So I think banks will be especially the corporate facing banks will fly very soon. You'll start seeing re-ratings happen. ICICI Bank, Axis, SBI, in that order are looking so promising from that perspective.
So just one sector, I thought I would have moved there. That was my last question. So let me ask you a second last question on the insurance companies, and both life and general, very promising. You see, if you think about it from a long-term perspective, India being such an under-penetrated market, more on the general side, the health side, and the motor side, even in life insurance. But the stock prices haven't done well. You look at an HDFC Life, you look at any of these stocks, kind of have not really done well. What do you think on this pack, on the insurance, both health and life insurance sector?
So I think it's a no-brainer. Everybody knows that these are sectors that have no reason to slow down. I mean, I don't see any reason why insurance life or non-life could slow down as compared to the previous years or, the historic trend. The question is, how much do they continue growing, right? Now, what happens is that if you try anticipating growth for just 1 year or 2 years, it's difficult. But the way financialization has changed your own industry, let's say broking,
Yeah.
I mean, what's happened in the last 2 years took 10 years, probably more, to happen in terms of participation levels. And what is the
Yeah.
single reason we keep on talking about the pandemic, but it's not the pandemic? I think the simple answer to that is digitization. Now, because you have the ability to open an account, operate an account, multiple devices, there's reach, mobility of devices is such a given. That's changed everything. Now, even in insurance, the moment application, underwriting, the claim process keeps on getting digitized and standardized, I think it's going to be phenomenal in terms of the ability for people to adapt to it and to accept it. So right now it's seen as a deterrent. There's too much of paperwork. I don't understand. I don't have choices. But as the democratization of insurance happens, of insurance products happens, simplification happens, I think it's going to be a huge industry. So it might take time. That tectonic shift, I don't know when it happens, but as and when it happens, it will give you growth of the last 4 5 years of slow growth in just 1 year, right? So you have to wait for that. So it's best to invest in a basket there. I
Yeah.
don't think I can take a call whether SBI will do well or HDFC Life will do well. They're different growth trajectories and parameters. The best is to buy a basket of these insurance players. So let's have three non-life, three life, and just kind of make a basket for yourself, equal weighted, and then right on. But that's for the long term. I don't think
Yeah.
you can trade on a daily basis.
Yeah. Prakash, I think I mean, really, I think you got one pulse of the brokerage industry right, where you said that one of the big movers, obviously, COVID, I mean, was one. But what you rightly, very importantly said, there is the digitalization. In brokerage business, I mean, account opening used to happen through physical forms 10 years back. There was a 30-pager form, and now accounts are getting opened on the phone in 5 minutes. And that's really been one of the reasons why tier 2 cities, tier 3 cities kind of participate. And I kind of really, echo what you said. So, pretty interesting, Prakash, your thoughts here. So last question, actually, I can keep on going on, but I think in the interest of time, I will kind of, make that a little shorter now.
Sure.
Okay, so let me just attempt one more sector, which is the hospitals.
Yeah.
Again, I think, from a long-term perspective, the kind of health costs which is there. I mean, earlier, 5 years, 10 years back, a lakh rupee bill used to be a decent bill. I mean, high bill. Now, it could be 3-4 lakh rupees is a normalized bill. And perhaps in a few years' time, 8-10 lakh rupees could be a normalized bill, if you really, unfortunately, if you happen to be, operated. I mean, you think the sector is poised for a clean run over the next few years? I mean, not talking about short term here.
Oh yes, so I think it's more formalization. So what's happened is, if you see the way the size of multi-speciality clinics and hospitals in smaller towns is growing. So if you recall, 5 years back, you would pass through a small hospital and it would boast of so many things. But now when you go, the size has gone up. The premises looks much more larger, much more well equipped. The ambulance is standing around. There's much more organizational this thing, efficiency that's built in. Right now, sort of, it's a supplier's market. Hospitals are getting away with whatever they want. There's not much of ability for us to look for something more economical. You go to a hospital, you don't even look at the rate card. It's only when the bill.
Very unfortunate. Yeah.
So right now it's about that. So healthcare in India is going to be something like, I think it's going to be very similar to so many other industries and sectors, service sectors, that whether it's airlines, whether it's logistics, there's going to be lots of these things which are telecom. You'll have all of that. But hospitals, by and large, will eventually end up facing their own share of growth issues like shortage of talent. Okay, because remember, we don't have as many medical colleges churning out doctors. So you could set up hospitals with simple capex, but if you can't man them with the right talent and skill set, it's of no use. And it's a very skill set driven business, right? I mean,
Yeah.
if you have good
Yeah.
trained, experienced doctors. Now, when you get experienced doctors, if I had to set up a multi-speciality hospital, uh, forget about a chain, even a standalone hospital, to hire the best of consultants and physicians and people to come and work out there, you'd have to draw them from somewhere else because there's not much of talent going around. So I think if you ask me, eventually hospital and medical education is going to be one of the sunrise. It is a sunrise sector. It is going to explode in terms of the growth, nursing, medical colleges, all of that. So it's happening. It's formalization of that sector. Still long way to go. Right now, they're making money on the easier things, right? It's pricing power that they have. Somebody's opening pharmacies, diagnostics, and all of that. But it's definitely going to be something where you won't lose money. I don't like some of the pricing pattern that hospitals have. It could border on being exploitative, but yes, from a revenue generation perspective, they are cash machines, and they will continue to do so for a long time to come. Yeah.
Very interesting, Prakash, again. So last, I'm going to ask you, and this is to a trader community, who are looking at markets, not that luxury of a very long term, but looking at the markets over the next 1 to 2, 3 months. So from a levels perspective, and technicals, short term is more levels. So 16,800, 16,600 held few times, 2 times, and right now we're kind of in the middle of the range. You think this level holds, and suppose it doesn't, where do you see markets going? And again, on the upside, if we break out of 17,800 range or around 8,000 range, where do you see markets being over the next 1 to 2 months?
Yeah, so I wish I was so good at levels myself. But what I do is I try and extrapolate the EPS growth that you have from, let's say, the Nifty company. So if FY22 we close with an estimated EPS of 730 on the Nifty, on the 50 companies that you're talking about, you need to look at what kind of a markup you want to give to that, and extrapolate that to FY23, and then give it a multiple. But if you ask me, on the Nifty, the correction has been very healthy because the P multiples that had expanded were quite high. So we could test 18,300 or whereabouts at some point in time again. That's not unthinkable kind of a level. But I don't think the market has so much of downside. If you ask me, the downside also is restricted given the fact that there's a lot of cash waiting on the wings domestically, whether it's mutual funds or whether it's PMS managers, whether it's HNI. A lot of smart money pulled out last year itself, end of last year towards November, December. So all of that will get redeployed once they get some clarity on the way forward. That's why the markets probably have the advantage of being cushioned on the downside as well. And the upside is, of course, subject to exuberance. But I think for traders, the best thing to do is to be contrarian. If the market gives you a dip, don't wait for another day, buy that dip. If the market has gone up, don't wait for the second day, follow through buying, you book your profits and be very nimble. It's more like scalping, these days.
Yeah.
So I think the market is going to remain choppy. Volatility is at its, historic highs. I think scalping makes more sense than anything else in this thing. But option writing and all, which is the complex part of trading, is going to be fraught with a lot of risk. So the risks are high, the premiums are high, but you could your capital very fast and very easily.
Yeah, Prakash, pretty interesting. I can tell you each section, each part of it spoke about, even the last part, the scalping part and buying the dips. I think really has worked. I don't know how long, but I think in this market in the last 1.5 years, what has really worked is buy the dip. I don't know about the future, but it's really worked. Prakash, thank you so much for your time today. Really, enriching session, really interesting. Thank you so much.
My pleasure. Thanks. All the best. Thanks. Bye.
Thank you.
Investments in securities market are subject to market risks. Read all related documents carefully before investing.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.